is net present value, IRR, internal rate of return for any long-term project using Excel. At the same time, I will also discuss in the same video the sensitivity analysis, break-even analysis and scenario analysis. Okay. Now, these are the inputs for determining the value of NPV and IRR. The life of the project is 7 years. 7 years is the economic life of the project. Just these are the data. I am not reading it. These are the data. These are the inputs. Okay. Financial parameters are this and the input parameters. That's the investment amount, sales volume, unit variable cost. All these are given. Corporate tax, depreciation. Okay. Next. And this is the analysis for finding the net present value. Okay. To look the detailed calculation, see the Excel sheet. How the calculation is done. This is the Excel sheet and the same inputs are noted here. The same inputs which I have shown in my previous slides. Investment amount 10,000, sales volume 1,000, all these are the inputs and this is the Excel sheet, and I think it is very basic things of the Excel. The formulas are noted here only. This is the formulas for computing revenue. I am just reading 2 or 3 items. Say I am reading this how it is calculated. This is the formula C4. C4 means what? C, this is Excel sheet. C4 is the sales volume, that is units, 1000 units. Okay, and per unit, now what is the formula? Formula C4 into C6. Where is C6? C6 is this. This is unit variable cost. Unit, and this is the volume. This is the unit variable cost. This into this. That's why this is the formula of Excel by which this is computed. Okay. Now, if I change the value here and say the unit variable cost, instantly this amount will be changed. I can show you also. Suppose if I make it 6.00, then the value will be changed. In place of this, you see 6,000 in this way. So what was the value? 6.75. I am keeping the same value. I am not changing it. Now all the values are calculated, variable cost, fixed cost, year wise computed. These are the formulas. I have noted the formulas here. Okay, I am not going to discuss in detail here again because I have already prepared one video. I will give the link. You can see there. I have discussed there in detail. And this is the NPV by using the formula of NPV. It is calculated. If I change any value, then the NPV will be changed instantly. And this is the IRR also. How it is computed, this is the formula and the detail I have discussed in my other video. I will show the link from where you can get that video also. Okay, in this way, the value of NPV and IRR has been computed. Okay, and if I change any value, instantly the NPV will be changed accordingly. That is the advantage to use by Excel, because for doing the sensitivity analysis, we have to compute several numbers of NPV, and for that we will take the advantage or use of this Excel sheet. Okay, and how this has come I also discussed in my previous video. I am not going to repeat it again. Okay, now we are returning back. Don't save because I have changed it, and this is the same 4,972, and this is the value of NPV, and this is IRR. Just now I have discussed. Okay, now sensitivity analysis. This is the overview of the sensitivity analysis. What is it? Actually, what is sensitivity? It examines the impact of changing one variable at a time while keeping all other all other variables as constant. Variable means what? Say sales price, variable cost per unit, and units volume. All these are the variables. If you change any variable, then what will be the effect on the NPV? That we'll see through the sensitivity analysis, and which variable is sensitive. That means if we change slightly that variable, instantly the NPV will change significantly. That is, it is very sensitive. Even in the reverse direction, if the input variable is slightly go down, then the project may be unviable due to highly sensitive. That we have to identify through sensitivity analysis. Why use it? Again I am repeating why. What are the uses of sensitivity? Sensitivity analysis identifies which input variables, key risk variables, have the greatest impact on project viability. That input variables, that risk variables will be detected by sensitivity analysis. Easy to use, it is not very complicated. You can use, no complicated software is required. And the main limitation of sensitivity analysis is it ignores interdependence between variables. In reality, variables often move or change together. That also I have discussed in my previous video. Okay, that's why I am not going to discuss more here. Now next, and these are the different situations. These are the different situations for which we will calculate the NPV value for sensitivity analysis. Okay, we are considering here three status of the project: pessimistic, expected, and optimistic. Pessimistic means when everything goes adverse, and it is the expected means normal things, and optimistic means when everything is going favorable. So that means in that case we have estimated the input parameters value will be this. Say for pessimistic the volume will be 750 instead of 1000. That means it goes down by 25% if it is pessimistic. In this way 10% reduce of the unit variable cost, not reduced as it is cost increased. That's why in place of 6.75 it has been increased to this. Okay, so if these are the values of the variables, then what will be the value of the NPV? Because your acceptance of the project will be depend on the value of NPV. To accept the project, the NPV must be greater than 0. That is our basic assumptions. So we have to calculate the value of NPV for the same project considering the value of volume not 1000, which we have already calculated 750. Then what will be the NPV? If the unit selling price is this, then what will be the NPV? Only one input will be changed and see the result. How will calculate? Again we are going back to the Excel sheet and see the calculation, because it is easy to calculate through Excel. This is the inputs just now you have discussed through the PowerPoint slide. 750, 12.5, and if the value of the volume is 750, what will be the NPV? These will be the NPV. You can calculate it instantly. I can show it. For the same project, only I am changing this volume as 750. You will see minus 1000. You note down and can check it. 750. Now sales volume 750. I am doing this 750. Instantly you see the calculation is 1146. Just now I have told you 1046. In this way all calculations you can make instantly by changing that variable. In this case only one variable I am changing, at a time. So again I am going back to make it original situation. Okay, again you can see the NPV value is this, expected value 490. This is the normal situation. Okay, and this is pessimistic situation, and you can see the maximum change has been placed when volume is changed. That is, the change of NPV is this significantly. The NPV negative means the project will be rejected for this pessimistic situation, but still for the case of unit variable cost, instead of pessimistic situation, the project may be accepted as the NPV is positive. Okay, NPV is positive. It is lower than the expected value, but it is positive. So we can say these two parameters, these two variables, volume and unit selling price, is very sensitive. You should be careful for estimation of these variables. Okay, and if you do any mistake, then your project may go, don't save, because we are keeping the value as it is. Now these are the different NPV values. Okay, so we have identified that volume and unit selling price are the most sensitive variables for this project. If any sales volume and unit selling price carry the highest sensitivity. Okay, widest NPV swings. Next, now advantage of sensitivity analysis. You see, I'm not reading detail. Pinpoints high risk inputs, just I have discussed. Guide data collections. For the sensitive inputs, you should be more careful. That is the guiding factor, because these are very sensitive. If you do any wrong estimate, then your project may be to the rejection category. Prevent risky investment. This will help, because if you be careful for the sensitive inputs, then you can prevent your risky investment. Now break-even insight. Determine how much a variable must change for NPV to reach zero, because that is the break-even concept. That means your sensitive variable, how much you can change so that the NPV goes to reduced to zero. Beyond that, the project will be rejected. And these are the limitations. First, ignores variable interdependence. I also discussed in my previous video. You can read it here also. I am not going to discuss in detail. Real world example, a price cut may simultaneously increases sales volume. Only price cut you will consider, that is not practical. Reduce operating costs sometimes. Consequences, risk may be systematically under or overestimated when variables co-move, means go together simultaneously. For this reason, we have to do the scenario analysis, and also we will mention the Monte Carlo simulation technique, okay, for better analysis. Now break-even analysis and scenario analysis. Acha, here I am going to mention, this is my previous video link. This link is for the previous video where I have discussed the calculation of NPV, IRR and sensitivity analysis in detail. Till now I have discussed. It has already been done in this video. If you have any doubt, you can see that video where I have discussed in detail. Okay. Now break-even analysis. Break-even analysis, what is the purpose of it? It is identify the key variables by sensitivity and then find the cutoff value at which NPV is equal to 0. That is the cutoff value of the sensitive variable. Sales volume, break-even. First I am going to show you how to calculate the break-even of sales volume. That is, if you go down of this volume, then your project will be rejected. You cannot accept it as the NPV value will be negative. How you determine it? And also I will show for the price, as it is also a sensitive variable, the break-even level. Okay, and to discuss it again, we are going to discuss through Excel sheet where we have done the actual computation. You can see it. Okay, now up to this we have discussed. This is for sensitivity analysis. Now this is for break-even analysis. This is the net cash volume or cash flow, you can say. How it is computed is revenue minus expenses per unit, and this is the tax saving, and this is the value for tax saving, tax shield for depreciation. Okay, now 1000 is the unit, per unit sales price is 15 and the variable cost is 6.75. That's why saving is this into 1000 minus fixed cost. This is the total revenue, and after paying the tax, the surplus is tax percentage is 0.35. That's why 1 minus 0.35 is the savings. Okay, and this is the revenue year after year we will get up to 7 years. Every year we will receive 2763 cash inflows, and its present value 12% is the discount rate. That's why this is the cumulative discount rate. After 1 year the discounted value will be this, for at the rate of 12%. In this way, through formula we have done it. You can see the formula here I have given, and this is the cumulative formula. And if you multiply with this, and this is the total present value of the revenue. Okay, savings. Now what will be the total present value? And that will be calculated in this way. For depreciation you will get this total cash inflows. How it is computed? Because your initial value is 10,000 and finally it will be reduced to 0, and the reduction rate is 25% and tax shield is 35%. If we apply this formula, then you will get the present value of depreciation tax shield. That means tax saving will be this. This is the total present value of the tax shield due to depreciation. And depreciation amount, how it is calculated? It is the reduction WTB method. Initial value is 10,000 and year after year at the rate of 25% it is decreasing till it is reached to 0. And if you consider that concept, you can apply this formula. I am not going to discuss this formula. This is as the reduction rate is uniform, that is 25%, and tax saving is 35%, and this is the formula of reduction formula, and ultimately this will be the present value of tax saving. Now what is the total net present value? Present value of the net cash flows. So every year I have already discussed, this is the formula you can see, and it will be is equal to 0, as NPV is equal to 0 is the concept for break-even year, not it is the management accounting or cost accounting break-even concept. Here is the financial concept of break-even, at which NPV is 0. NPV is 0, net present value. Net present value is computed in this way. Net cash flows year after year. This is the cash flows year after year. You have to compute the value of V. What would be the value of V? Means volume for which the NPV will be 0. So this is the sales price per unit, and this is the variable cost per unit. Per unit saving is this, and into multiplied with the volume, and this is the total revenues minus the fixed cost into 0.65. Why 0.65? Because 0.65 is the retained revenues, 0.35 is the tax, and year after year you are getting this, and for 7 years this is the cumulative discounting factor, and this is the total cash inflows present value, plus this is for the depreciation tax shield. Just now I have discussed 2365, and this is the total present value of the cash. And again I am showing you how 2365 amount is come. 2365, just this is the depreciation amount. Okay, so this is the 2365, this is the total present value minus 10,000 is the initial investment, that must be equal to 0. And if you solve this, and I think it is not very complicated to find out V by solving, then you will see the value of V is 797. That means till the volume reduced to 797 and incorporating the 3 zeros, that is 7,97,000 units, the NPV will be 0. Now if the volume reduced by even a single unit, the NPV will be negative. That means the project should not be accepted, the project will be rejected. This is the cutoff. If the management or decision taker know this value, then it will be easy for him to take decision, because the standard value or estimated value is 1000. If it decreases, as it is sensitive, no problem, it is, if it is raised to 800, this value is 800, I am not going to incorporate these 3 zeros, 800, still the project will be positive. But if the volume is 795, then NPV will be 0, and after that, now if it is 796, the NPV will be negative. That's why it is called the break-even point of the volume. Similarly, we can also find out the selling price. In this case, P is unknown. In this case, V is unknown, volume. In this case, P is unknown. So 100 into, we can say 100 P minus 6.75, sorry, this will be 1000. I am changing a one parameter, 1000. This will be 1000, not this will be 1000. Okay, P minus 6.5 minus 4000, and in this way it will be is equal to 0 for break even, and you can calculate it. The value of P will be 13.35. The standard value we have taken 15 rupees per unit. If it is decreased even till 13.32 per unit, then NPV will be 0. But if the price is reduced more than 3.35, this is the cut-off price, then NPV will be negative. Okay, I am not going to prove it, but you can check it as it is computed through formula, then there is no problem. Okay, now in this way you can find out the break-even point. Okay, now this is the computation through Excel sheet. Now see the next. We have reached the best scenario analysis. Now we will discuss the real world situation. One slide. Again I am repeating. Up to this we have discussed. Now see the overview of the scenario analysis. Scenario analysis evaluates different states, scenarios of the business environment simultaneously. The normal practices, the standard scenarios are pessimistic, optimistic, and most probable. Pessimistic means worst case, all variables at unfavorable levels, and optimistic means best case, all variables at favorable levels. Normal, most probable is the normal or base case, that is realistic or expected values. Computation, computing all scenarios, computation are performed again through Excel sheet. Okay, the variables are interrelated, real world, That's why it is done. Example, a price reduction may trigger a higher sales volume. Altered variables cost and different fixed cost absorption, everything. Why sensitivity analysis falls short? Sensitivity analysis handles only one variable at a time. Okay. Now simultaneous variable changes, best case, worst case, and most likely cases, more realistic. And these are the different scenarios, and accordingly the value of the variables are noted. The experts or decision takers have estimated different situations. This is the best situations, and accordingly the value of the variables are this. Best situation, sales volume is this, sale price this, and if the situation is pessimistic, then the expert or decision taker estimates that the sales volume will go down to 750, because pessimistic, sales will down, selling price down to 12.75 instead of 15.75. In this way, variable cost will increase as the situation of pessimist will increase up to this, and the fixed cost will increase to this. If the optimistic, that is, if the situation is favorable, then the sales volume will increase. In place of 1000, it will be 1250. In place of selling price 15, it will increase because it is a favorable situation. And if we calculate through Excel sheet, as I have shown you, only you change the value of the variables instantly, you will get the value of the NPV. So you will get the NPV of all the scenarios. That is, at the case of pessimistic situation, you should not accept the project because the NPV is negative. But base case, it is acceptable. Even expected case, the NPV is 3000,044. It is also accepted. Only pessimistic situation, you should not accept this. And NPV, how it is calculated, 3044, it is shown here, because in this case the sales value is 1250. This is the revenue, selling price, sale price minus variable 7.1. This is surplus for 1 unit multiplied by 1250, and minus this is the fixed cost, and this is the saving, and multiplied 0.65 to get the actual savings reduced, because 35% we have paid the tax. The remaining amount will be this, multiplied the cumulative discounting factor for 7 years, because every year this amount is getting 4.5 plus this is for tax saved for depreciation at present value, and this is the total present value minus 10,000 is the outflow of fund. And this is one case I have shown here. In this way you can calculate for all this also, or you can use the Excel sheet direct also, you can check it, no problem. Now conclusion. Scenario analysis. Scenario analysis provides a more realistic and holistic risk assessment by considering simultaneous variable changes, not only one variable change as sensitivity analysis. It captures variable interactions that sensitivity analysis misses, or it was not done, making it a more robust tool for project evaluation. But better investment decision combining NPV, IRR, sensitivity analysis, break-even analysis, and scenario analysis gives decision makers a comprehensive toolkit. Each method adds a unique lens to long-term project appraisal. Now, best approach. Best approach is Monte Carlo simulation, because in this method the probability is considered. Till the methods we have discussed, here we have considered the probability. That means we have taken the value as deterministic, but in the real world it is not like that. That's why simulation technique is more scientific. Simulation approaches is the most comprehensive method for long-term investment risk analysis. Probability distributions. Instead of fixed point estimates, it assigns probability distributions to each uncertain variable. That's why this method is more useful, more scientific. Random sampling is also used, and output provides a range of probability distribution. In PV-IRR becomes in the full method. I have made a separate video for Monte Carlo simulation. You can check it, and in that case, there you will get the detailed idea. Okay, Monte Carlo simulation goes beyond scenario analysis by modeling the full probability space of outcomes. Thank you very much, and if you have any doubt or query, please note down to the comment box, and I will definitely reply at the earliest possible. Thank you.